Level 1, the dream. You're not a buyer yet. You're a Zillow browser at 11 p.m. who has started using the word equity in conversation. It starts on your phone. Zillow, Redfin, Realtor.com. You're not looking seriously. You're looking the way you look at vacation destinations you can't afford yet. With a combination of aspiration and math that doesn't quite work. You filter by price. You adjust the filter. You look at what $350,000 gets you in your city versus 3 states over. You screenshot kitchens. You send listings to your partner at midnight with the message, "What do you think?" You start saying the word equity in conversations where you previously would have said, "Money I'm not throwing away on rent." This is the first sign that something has shifted. You run a mortgage calculator for the first time. You type in $380,000 at 7.1% interest over 30 years. The monthly payment number appears. You stare at it. You type in a lower number. The payment changes. You do this 7 times, negotiating with a calculator, trying to find the version of homeownership that fits in your current life. The calculator doesn't lie. You're not ready. Not because you never will be. Because you're missing 3 things right now. The down payment, the credit score you haven't checked in 8 months, and the clarity on what you can actually afford versus what Zillow shows you when you remove the price ceiling. This level has a specific danger. It looks like preparation and feels like progress, but produces no actual movement unless it leads somewhere. The people who stay at level 1 indefinitely are the ones who make Zillow browsing a hobby rather than a research project with a deadline. You give yourself a date, not someday, a date. Level 2, the credit reckoning. You check your credit score. The number is either better or worse than you thought. Now, either way, it's going to cost you. You pull your credit report on a Sunday afternoon. The score loads. You feel one of 2 things, quiet relief or the specific sensation of your stomach dropping 2 inches while your face stays neutral. Here's why this number matters more than almost any other number in the home buying process. On a $380,000 mortgage, the difference between a 680 credit score and a 760 credit score is approximately $180 per month in your mortgage payment. Over 30 years, that difference is $64,800. The credit score isn't vanity, it's money. Specifically, it's the price you pay for every past financial decision that showed up on a report. You find things on the report you forgot about. A collection from 2019, a $340 medical bill that you didn't know went to collections because it went to an old address. A credit card you opened in college that you barely used and eventually ignored. A late payment from a hard month 2 years ago that is still sitting there, quietly costing you. The medical collection can potentially be disputed. Medical debt under $500 was removed from credit reports in 2023. The late payment will age off eventually. The credit card, with no balance but also no activity, is actually hurting your utilization ratio. You spend 2 weekends fixing what can be fixed. You dispute the collection. You make sure every account with a balance is below 30% utilization. You don't close the old card. Closing it would reduce your available credit and hurt your score. You just use it for a small purchase and pay it off. 3 months later, you check again. The score has moved 17 points. That's not enough to change your life, but it might be enough to change your rate. This is also when you find out what you actually earn on paper versus what you think you earn. Lenders look at 2 years of tax returns. If you're self-employed or have variable income, the number on your returns might be lower than your actual cash flow because of legitimate deductions. And lenders use the tax return number, not the cash flow number. Some people discover at this stage that they make significantly less money on paper than they thought they did. The preparation for a mortgage starts well before the mortgage application, usually at least a year before. Level 3, the savings reality. You need $80,000. You have $14,000. The math requires a plan, and the plan requires time you wish you'd started earlier. The down payment conversation has 2 versions. The version in the financial advice articles, save 20% to avoid private mortgage insurance, have 6 months of emergency fund remaining after closing, have 3 months of mortgage payments in reserve, have closing costs covered. The version in real life. Most first-time buyers put down between 3% and 10%. FHA loans allow 3.5% down with a credit score of 580. Conventional loans allow 3% down with strong credit. The 20% rule is not a rule, and it's a guideline that became a cultural expectation that many people cannot meet, especially in markets where home prices have outpaced income growth for a decade. Here's what 3% down on a $380,000 home looks like in practice. $11,400 down payment, plus $10,000 to $14,000 in closing costs, plus PMI, private mortgage insurance, of approximately $150 to $200 per month until you reach 20% equity. The PMI is the cost of putting less down. It's not a punishment. It's insurance the lender requires to protect themselves if you default. You do the math on your savings. Current balance, $14,000. Target, $25,000 to cover down payment on a lower price point and closing costs. Monthly savings capacity, $800 after expenses. Timeline, 14 months. This is the level where abstract homeownership desire becomes a concrete savings plan. You open a separate high-yield savings account and name it House. Not to be cute, because naming it makes it feel wrong to pull from it for anything else. You automate $800 on the first of every month. You stop looking at Zillow for 3 months because looking at houses you can't buy yet is a motivation drain dressed as research. A first-time homebuyer program in your state offers down payment assistance, a $10,000 forgivable loan if you stay in the home for 5 years. You spend an afternoon researching it, you qualify, the timeline shrinks. You also learn about seller concessions when the seller pays some of your closing costs as part of the negotiation. In a buyer's market, this is achievable. In a seller's market, asking for it gets your offer ignored. You learn which market you're in. Level 4. Pre-approval. A lender looks at everything. Your income, your debt, your bank statements, your soul, then they tell you a number. Pre-approval is not pre-qualification. Pre-qualification is a lender taking your word for your income and debts and giving you an estimate in 10 minutes. It means almost nothing. A pre-approval letter involves the lender actually verifying your income, pulling your credit, reviewing your bank statements, and committing to a loan amount contingent on finding a property that appraises for the price. Sellers take pre-approval seriously. They treat pre-qualification as background noise. The documentation you need: 2 years of W-2s or tax returns, 2 months of bank statements, recent pay stubs, an explanation letter for any large deposits in your bank account that don't match your regular income, a gift from family, a bonus, anything that looks unusual. Lenders are looking for evidence that the money in your account is real and sustainable and not borrowed. The gift letter. If family is contributing to your down payment, which is more common than people admit, the lender requires a signed letter from the donor stating that the money is a gift, not a loan, because a loan would affect your debt-to-income ratio and might disqualify you. The letter has a specific format. The lender provides a template. This is normal and legal, and approximately 1/3 of first-time buyers receive some form of family financial assistance. Your debt-to-income ratio is the other number that determines everything. DTI is your monthly debt payments divided by your gross monthly income. Most conventional loans require a DTI below 43%. FHA allows up to 50% in some cases. If your student loans, car payment, credit cards, and future mortgage payment combined exceed 43% of your gross income, you either don't qualify or you qualify for less than you hoped. You get the pre-approval letter. The number on it is either exactly what you needed to hear or a gentle but specific reality check about what the market in your area can offer you at your approved amount. You stare at the number. You calculate what it means in monthly payments. You compare it to rent. The conversation about whether buying makes sense in your market at your income at current interest rates is genuinely complicated. And anyone who tells you it's obvious in either direction isn't doing the math specific to your situation. Level 5. The search. You've made 11 offers. You've lost 9 of them. You're starting to understand the market personally. The first house you love goes under contract the day before your showing. The second house has foundation issues the inspector would have caught if you'd gotten far enough to have an inspection. You learn this from the listing agent who mentions it casually after the fact, in a way that suggests it was not mentioned before the fact for reasons you can infer. The third house you offer $15,000 over asking, no inspection contingency, 21-day close. You lose to an offer $8,000 higher than yours. The fourth house, you offer $22,000 over asking. You write a letter to the sellers, a personal letter, explaining who you are and why this house matters to you. Because you read that it sometimes helps and you're running out of moves. You lose again. This is the part of home buying that the process doesn't prepare you for emotionally. The paperwork, the pre-approval, the savings, those are solvable problems. You work on them, and they improve. The search in a competitive market involves loss that has nothing to do with your qualifications, your offer, or your commitment. Someone else just had more cash, or they waived more contingencies, or the sellers had a personal connection to their offer. You did everything right and you still lost. The escalation clause. You learn about this after losing twice. An escalation clause says, I'm offering X, but I'll beat any competing offer by Y up to a maximum of Z. It removes some of the guesswork from competitive offers. It also shows your ceiling to the seller, which some agents advise against. You try it on offer 7, you win the bid, then you worry you overpaid, then you check the comparable sales and realize you didn't. You almost win offer 5 and lose at the appraisal contingency. The house appraised for $14,000 less than the offer. In a competitive market, sellers often expect buyers to cover appraisal gaps, pay the difference between the appraised value and the agreed price out of pocket. You didn't have the cash to cover it. You lose the house, you go home and don't say much that evening. Offer 11 is accepted on a Thursday at 4:47 p.m. You sit with your phone in your hands for a minute before you call anyone. Level 6. The inspection. The inspector finds 47 items. You learn what matters and what doesn't, and the difference costs money either way. The inspection lasts 4 hours. The inspector goes through the house systematically. Roof, foundation, electrical, plumbing, HVAC, windows, insulation, drainage, and produces a report that is usually between 40 and 80 pages long and contains everything he observed. From the water heater that's past its expected service life to the missing GFCI outlet in the bathroom, to the section of gutters that isn't properly secured. The report arrives at 9 p.m. You read it at midnight. By page 12, you are convinced you are about to buy a disaster. Here is what the inspector will not tell you: which items are deal breakers and which are normal wear on a house that has been lived in. The report documents everything. The interpretation is yours. Some buyers panic at a 60-item report on a house that is structurally sound and competitively priced. Some buyers ignore a 15-item report that contains one item in the foundation section that means the house has a serious structural problem. The hierarchy of inspection findings critical: foundation cracks indicating active movement, evidence of major water intrusion, knob and tube wiring throughout, galvanized steel pipes throughout, evidence of mold in the HVAC system, roof with less than 2 years of life. These are the items where you either negotiate a significant credit, require remediation before closing, or walk away. Significant but manageable: HVAC at end of life, water heater older than 12 years, roof with 5 to 8 years remaining, single pane windows, minor electrical issues. These items are negotiating tools. You ask for a credit or a price reduction. Normal wear, loose door handles, minor caulking issues, bathroom exhaust fan that's louder than optimal, missing weather stripping. These are home maintenance items, not problems. You send a repair request to the seller. You ask for $8,500 in credit to address the HVAC and the roof. The seller comes back with $5,000. You negotiate to $6,500. The deal holds. The inspection contingency is what made this possible. Without it, if you waived inspection to win the offer, you'd own whatever is in that report with no recourse. Many buyers in hot markets do waive inspection. This is a real financial risk dressed as a competitive strategy. The calculus changes depending on the house, the market, and your personal risk tolerance. Level 7. The closing table. 47 signatures. You own a home. You also just learned what closing costs actually means. The closing disclosure arrives 3 days before closing. Federal law requires it arrive at least 3 business days early so you have time to review it. You read it 3 times. Some of the numbers match what you expected, some of them don't, and the ones that don't require phone calls to your lender to understand. And some of the answers are satisfying, and some of them are, "This is standard," said in a tone that suggests the conversation is over. Closing costs on a $380,000 home, itemized, origination fee, $1,900, appraisal, $550, title search and title insurance, $2,200, recording fees, $280, prepaid homeowners insurance, $1,400, prepaid property taxes, $2,100 into escrow, prepaid interest, $780 for the days between closing and your first full month, attorney or title company fee, $800, total, $10,010, plus your down payment of $15,200 at 4%, total due at closing, $25,210 paid by cashier's check or wire transfer because personal checks are not accepted. You sit at the table. A notary or closing attorney walks you through 47 pages of documents. You initial here, you sign here, you initial here again, you sign your full legal name here. Some of the documents you have 3 seconds to understand and they don't pause long enough for more. You sign the deed of trust, which means if you stop paying, the lender can take the house. You sign the note, which is the actual promise to repay. You sign the closing disclosure acknowledging you received it. You sign the truth in lending disclosure. You sign documents about lead paint, flood zone status, the right to rescind, which doesn't apply to a purchase transaction, and your acknowledgement that the property was appraised. 47 signatures. The notary hands you a set of keys. You own a home. You drive home in a car that is not yet fully comprehending what just happened. You unlock the door. You stand in the empty house for a minute. Level 8. Month 1 of ownership. The water heater makes a sound you've never heard before. You don't know if it's normal. This is now your problem. Nobody warns you about the silence of homeownership. In an apartment, something breaks and you call someone. The toilet runs, the heat doesn't work, the disposal dies, someone else's phone rings. Now your phone is the phone that rings. Or more precisely, nothing rings. You just hear a sound, or notice a drip, or see something that might be nothing and might be $4,000. And you have to figure out which one it is using knowledge you don't have yet. The water heater makes a sound. You Google the sound. The results range from totally normal, this is thermal expansion, to this is your house exploding imminently. You call a plumber. It's thermal expansion. It costs $150 for the plumber to tell you this, which you pay because you don't know enough yet to know it's thermal expansion. You learn what thermal expansion is. You don't pay $150 for it again. The first month of ownership is a rapid education in every system in your house. Not because you wanted to learn it, but because you now live with the consequences if you don't. You learn what the circuit breaker panel looks like and which breaker controls which room. You learn where the main water shutoff valve is, which matters when the toilet connection under the sink starts leaking at 11 p.m. on a Friday. You learn that the HVAC filter needs to be changed every 90 days and that most homeowners change it every 14 months. And that the gap between those 2 intervals shows up in energy bills and equipment life. The hidden costs of home ownership that the mortgage payment doesn't capture, property taxes, usually escrowed but sometimes shocking when reassessed, homeowners insurance, which goes up, HOA fees if applicable, maintenance, industry standard is 1% of home value per year on a $380,000 home. That's $3,800 annually in expected maintenance, and the capital expenditures that come eventually. Roof, HVAC, water heater, windows, appliances. Month 1, your total housing cost. Mortgage plus taxes plus insurance plus the plumber plus the new air filters plus the thing you needed for the yard is $400 more than you budgeted. You adjust the spreadsheet. You add a home maintenance line item. You research what things cost before they break, so you're not Googling at 11 p.m. on a Friday in a panic. You're a homeowner now. The learning curve is steep, and the tuition is ongoing. But the keys are yours, and the equity is building, and the thing that was a number on a mortgage calculator is now the place where you live. And that is something the calculator was never able to fully account for. If you're somewhere in this process, subscribe. More of these coming. And drop a comment about what level you're at. You're further along than you think.